Hey guys, welcome back to the Capital Mindset Show. We are your hosts, Austin and Fabio, and today we're going to be talking about MKL. This is one of Fabio's favorite positions. He loves this company so much, and today I'm going to be asking him all the questions, and as always, he's going to have all the wonderful answers. So, without further ado, what are we looking at here today?
All right. So first, we always begin with the price action. So let's see the price action.
We always start with the price action.
Over the course of its history, this has already been a 100-bagger, which is, well, we can't extrapolate from the past and expect to the future. But however, if I explain to you the DNA of this business, Austin, you might end this video loving this company too. So I call this company Mini Berkshire. I'm not the only one. A lot of people call it Mini Berkshire. I have owned this position for quite a long time now. This is actually one of the OGs. And so this is kind of like this is my main insurance company. And what I love about this business is they follow a similar model to Berkshire Hathaway, which is basically they take insurance premiums and what they make on the insurance premiums, they don't invest it as normal insurance companies strictly in bonds. What they'll do is they'll do bonds, yes, but they'll expand into other forms of securities, such as stocks, such as privately traded companies. So, and the private part of the business, right, is called Markel Ventures. So Markel Ventures is this arm of the business that goes out and finds private businesses and then invests in them. So they'll look for a business that, for example, has some sort of edge, and then they will buy a piece of the business with the founder still having a large stake so that the founders are invested in the longevity of this business. So Markel over time has developed a broad portfolio. I think they just now bought a controlling stake in a concrete maker. Okay. So to show you that they are very, very, very diversified in terms of their business revenue at this point, and they will continue to do so. And the size that they're at relative to something like Berkshire Hathaway, they still have so much room to grow.
So now my question here is, you mentioned this is sort of a mini Berkshire Hathaway. Just to kind of summarize what you said, they take insurance premiums, and instead of really investing those into bonds, which we typically see with the insurance,
well, they do invest in bonds. They do.
Yes, but instead of being bond only-ish, they also invest in stocks. They invest in other different types of equity securities. And then next to that, they have almost a private equity arm as well, where they look for private businesses that have an edge, and then they invest in those, and the management is also heavily invested in these private businesses itself. My question here is, what does the ownership structure of MKL look like here? Are we kind of seeing, because this is, as you call it, a mini Berkshire Hathaway, are we also kind of seeing a mini Warren Buffett, a mini Charlie Munger?
Sort of. In the investor, the main investing officer, Tom Gaynor, he's been the one kind of running the show in terms of the investing arm of the business for quite a long time now, and he's done a fantastic job. The Markel family is still involved in the business, but they kind of take a more hands-off approach when it comes to the investing. That's more Tom Gaynor's forte. And the business itself, again, it takes that insurance premium, and that they do a bunch of interesting things in the insurance space. It's not the traditional car insurance or stuff like that. They do a lot of reinsurance. So insurance companies spread the risk by doing reinsurance. And then Markel offers a lot of that.
Well,
and
what is reinsurance? What is that for the context?
So to not make too long of a video and not get into this too much, but it's to spread the risk of insurance. So one insurance company will insure something, and to spread the risk, they seek out reinsurers, which Markel is one, and then Markel will insure the insurance, for example.
I'm oversimplifying. They probably do that based on collateral of the assets they have on their balance sheet, I would guess.
Yep.
That's how they insure the insurance in this instance.
Correct. And Markel will insure some interesting things, such as like artwork, for example, or the transportation of artwork. So interesting little things that they'll insure, not some things that people really think of when they think of insurance. So I like their business strategy, but I really, really like the growth of their portfolio over time. I think that as long as at this company they have good investors, that's the caveat, that the company will continue to find and compound my money that I've invested in them.
And now that's kind of interesting to me that they're applying a different approach here than other insurance companies, where instead of being bond only, they're also investing in stocks. My question is now, why don't the other insurance companies just do this same strategy if it's been working so well for Markel? Is it because maybe these businesses are bigger, therefore the ship is harder to
Yeah,
steer in this direction? Or is it because a lot of insurance companies by their very nature are very risk averse with these sorts of
risk
things, and
averse.
bonds offer a fixed amount of payments over time, and that might appeal to these insurance companies? So what I'm now extrapolating here is I'm seeing a company that isn't afraid to take risks.
Yeah,
Basically, they're willing to take a potential economic downturn or a recession of some kind, and in the endeavor that if their investments prove fruitful, that could be incredibly beneficial to shareholders. So I'm definitely getting like the DNA here. The DNA is making sense to me,
yeah.
or at
And
least I'm like starting to get it.
it's all of those things at the same time. So some insurance companies do different variations of that, between bonds, preferred stock, and then common stock. However, Markel is the one that's kind of like more directly copying Berkshire Hathaway. Actually, their largest portfolio position is, funnily enough, Berkshire Hathaway. So
That is funny.
yeah, that is funny. The management at Markel has always expressed a admiration for Warren Buffett. And even though he himself is now considered among the greats of investors, a lot they have a large portfolio invested. A large sum of their portfolios invested in Berkshire Hathaway, Google, or otherwise known as Alphabet, Amazon, Disney, stuff like that. And you're getting like a portfolio of publicly traded equities, but again, you're getting also a portfolio of privately owned businesses. So we want to highlight that as well. And Berkshire Hathaway is the same thing, by the way. Berkshire Hathaway has their publicly traded portfolio and their privately held businesses.
So they're spreading their risk then, Fabio.
Yeah. No, they have
multiple different avenues and ways of making money. That's what I'm seeing here. They're spreading the risk across the public sector, the private sector. I would assume they probably even have real estate holdings. Do they?
Yes.
Yeah.
They have they're like an ETF. I think of them as the ETF in my portfolio. That's what they are for me. So if I had Berkshire Hathaway, I would also think of it the same way as my ETF that I would never sell. But without an expense ratio, there's no expense ratio whatsoever. And instead, it's funny because Berkshire Hathaway and Markel are share cannibals, right? They eat their own shares over time. And we'll actually see that, but it's very slowly in very inopportune moments. Markel will buy back the shares. They don't really want to do that too much because instead of buying back shares, they would rather grab that cash and go invest it elsewhere. But they do that now and again, and we'll see that in the model, which I guess I'll pull up right now.
Which also this now primes my thoughts now. They must have a pretty exceptional return on invested capital then in this instance. So I, as a shareholder, or you even as a shareholder, would not really want them to do buybacks in this instance. Maybe there's definitely an added nuance here.
Yeah.
But
So it depends on what you think about the return on invested capital, because you have to separate their bond portfolio, because they need to have some part of their portfolio, just like Berkshire Hathaway, by the way, that you have to think about as cash in case the premiums, or not the premiums, the liabilities on those premiums actually come to fruition. So, because they are an insurance company at the end of the day. So if they tie up everything into portfolios of equities or privately held businesses, then that would be very responsible, because again, they are an insurance company.
Ask this question now for maybe some of our audience out there who might be new investors. What is an insurance premium? If you can just summarize what that is really fast.
So an insurance premium, in simple terms, is what you pay, right? So you pay the insurance company a fee, and then they're going to take that, and hopefully they collect fees from a bunch of people, and the amount that they have to pay out, right, to liabilities is less than what they collect as fees, right? And then on top of that, what they're going to do with those premiums is they're going to invest it into different instruments and generate returns on that capital. So they're going to hopefully generate money from the fees themselves, right? And then on top of that, they can generate money from investing, right? Typically, again, it's bonds, because bonds are considered to be safer. But some companies, some insurance companies will take that and invest in equities, privately held businesses, et cetera. So Markel Corporation is exactly that, just like Berkshire Hathaway. So Berkshire Hathaway is the big boy in the room. It's been doing this for a very long time. Markel for less long time. And Berkshire Hathaway has Geico, for example. You've probably heard of Geico. Geico is the insurance arm of Berkshire Hathaway. And Warren Buffett has talked extensively about the large cash position he has at Berkshire Hathaway. And a lot of people think he has a stupid amount of cash just sitting around. That's not necessarily the case, because he has to have that amount of cash for the insurance liabilities. He's stated this many, many times, that he's doing that because he wants Berkshire Hathaway to be a fortress that can withstand any kind of event. And if a lot of things happen that they have to pay out these liabilities, he wants the company to have that available to pay out those liabilities. Now, he does still have a decent amount of cash to invest, but not as much as people think. Okay. So here we can see Markel has a hold rating, 18% upside at a price target of 1,450. Austin, please, is this expensive?
That's
at 1,226.
Yes, it's very expensive.
Okay. So what I'm referring to is something that some new investors sometimes think is that a high price means it's an expensive stock. Well, that's not necessarily the case. So if we look, for example, at the P ratio, it's 7. So relative to other stocks, that's considered to be very cheap, because the earnings they generate per share is quite high. And I'll say this about insurance companies. Berkshire Hathaway, you can't really consider too much of an insurance company. It's not going to trade at the same discounts that other insurance companies will trade at. Insurance companies after the financial crisis have been perpetually cheap. This is kind of what I call, I don't know if it's a word used elsewhere, but I call this sector scarring. Okay. Sector scarring. So what is sector scarring? It's when something happens to a sector that leaves a scar on that sector, and it trades cheaply for a very long time. We have no idea when they are re-rated. Okay. So let's just be clear before we go further from there. We have no idea when they will be re-rated, but they may or may not. We cannot assume that they will. So we have to assume that for now, that Markel, other insurance companies will trade perpetually cheap. Okay. But again, that's what I call sector scarring. All right. So with as regards to growth rates, I do think 18% is rather high. I don't think that that's reasonable going forward. I don't want to assume that. So what I'm going to do is assume instead a midpoint of 10 and then the high point of 18. Okay. So midpoint of 10, and that's what it appears to be priced at. It's priced at 10% growth right now with a discount rate of 20%, and assuming they continue the buybacks opportunistically. I don't want them to do too many buybacks. I'd rather them take the cash and then reinvest it into new opportunities, or hold the cash and wait, because we have to remember this business, part of the business model is investing in other businesses. Okay. So I need them to hold cash and wait. And the one I'm most excited about personally, right? And I was going to address your point about return on capital, Austin, because we have to remember they have a huge bond portfolio. Before I get back to my old point,
it's nuanced. Yeah, because I saw that 10%, and I was like, wait a second.
Yeah, because the model is taking on, well, that's how you're supposed to calculate it, but the model is taking into account also their bonds, right? So the bonds are going to generate lots of return, but they need to have those bonds there because that provides like a cushion for their liabilities. It's
that cash. It's almost kind of that cash buffer that they need if those liabilities come to fruition, and they have to pay those.
So I think 10, and then let's do 5, and then let's do 2%. So I'll be transparent. So my position is in the 800s. That's where my position is. Yeah, this is one of the ones I bought a while ago, and then I was able to add during the 2020. And there was a long time that it was trading for 800. So you had a long opportunity to add this thing at 800. We were unfortunately not filming back then. So I'll say this now, but I actually personally am still adding to this position. I buy here and there. I think of it. I tell, for example, my siblings that this company is something they could buy and probably hold for their entire lives. In my personal opinion, that's what I tell them, and I'm their family member. So it's different for me telling the audience. I'm not going to tell you that, but that's what I do for my own personal portfolio. And it has a role in my portfolio as sort of that asset that I feel comfortable with
It's
adding in here and there, and I just never sell it. I don't
it's
plan on selling.
basically an ETF for you in this
Yes,
instance.
and I don't hold this one in a retirement account. I do not hold this
Yeah.
in my retirement account. I hold this in my non-retirement account because, for one, it's not going to be paying a dividend anytime soon,
And you're
and
also not
I'm not going
selling
to
it.
selling it.
Yeah.
Yep, I'm not going
Yeah.
to be selling it. So at this point, there's no need if I'm never going to sell
So
it.
I actually have a question now. There seems to be a common sentiment on YouTube where people are saying, oh, if this company doesn't pay a dividend, therefore bad. Why would this not be the case? Or why would you want to see Markel paying a dividend, or no? Does that kind of keep in line with all the things that you've been describing? And then if so, what is the nuance
Look,
maybe an investor watching this video should extrapolate from this?
I don't think Markel should be, it's not anywhere near where it needs to be paying a dividend at the present moment, because the business is a business that invests in other businesses and can quickly expand into new areas. I don't want them to take that money and give it to me. I want them to keep the money and invest and find new opportunities, or hold it and wait for new opportunities. Berkshire Hathaway is getting to the size where it's getting harder and harder and harder to find new opportunities. They would be one that I would be interested in them finally someday soon paying a dividend, because again, that's nuance. Now the opportunities are becoming scarcer and scarcer to move the needle for Berkshire Hathaway. All of those patient investors, it is approaching the time, and Berkshire and Warren Buffett has said this, it is approaching the time that someday soon, maybe after his passing, which will be a very sad day, that Berkshire Hathaway will finally pay a dividend, because the opportunities just won't be there as they were in the past, because Berkshire Hathaway will be too big. Right.
Yeah.
And so it'd be better to return that capital.
So if I'm understanding this correctly, another little nugget of knowledge for the investor is, as you accrue more capital, as you become larger, it becomes harder and harder to find those opportunities and make those big returns.
Yes. So yeah, the larger your portfolio becomes, the more difficult it gets for you to find new opportunities that move the needle. If I was running $100 billion portfolio, it would be very, very, very difficult than versus running $1 million portfolio. Warren Buffett has said as much. He said if he had $1 million portfolio, he could generate 50% rate of return each year because the portfolio is small enough. However, if you're running $100 billion, the task becomes exponentially more difficult, because there's only so many companies that you can invest in that would move the needle. You basically are locked out of investing in small, tiny companies. Markel is small enough that the smaller companies can still move the needle. For example, we looked at a company, Alteryx. It's $4 billion company. It's not saying it's a good investment, by the way. It's a separate topic. I'm just talking about the size of it. So if Markel, for example,
you're just using this for the sake of the example here.
Markel bought half of it, right? That's like $2 billion. So that would still move the needle for Markel if like Alteryx like doubled, right? So if Alteryx doubled, that would move the needle. But for Berkshire, if they bought half of Alteryx or all of Alteryx, if Alteryx doubled in value, it wouldn't really move the needle for Berkshire Hathaway. They had to invest. See, like Warren Buffett's been talking about this. He has the elephant gun, right? He's looking for elephants. Markel is still small enough that it doesn't have to find the elephant. It can find the nice little gazelle, right? And it can pick different sizes of companies. So that's an advantage as an investor. And Buffett's probably getting bored, poor Buffett, because he can only, he has to be more patient now than he had to in the past. But that's pretty much my 2 cents. I love this company, so I don't think I have a very biased take. So I think that this business for the very long term is going to be my portfolio for the foreseeable future. And I'm very happy with the performance so far. I'm looking forward to hopefully even more pullbacks, and that the scarring of this industry kind of remains. So that's all I pretty much have to say.
Yeah, because then, okay, cool. Well, with that being said, we are your hosts, Austin and Fabio. This is the Capital Mindset Show. If you've liked what you've seen here today, please be sure to share the video. It really, really helps out the channel. Please be sure to like, comment, and subscribe. Visit our website at capitalmindset.org, and take care, guys.